simply stating, lease is an agreement under which the owner who owns the asset, who has the right of the asset, allows someone else to use his asset in lieu of some consideration. So the person who is using the asset and making payment is known as lessee. Leessee. Can you see the last double E being underlined? The owner who receives payment is known as lessor. Okay, so how would you remember which party is known as what? Whenever you give something, you add OR to your name. For example, when you donate blood, you become donor. Okay, when you transfer something, you become transferor. Therefore, in this case, who is giving the asset to the other person? The owner. So therefore, owner is giving something, he will become lessor. OR. Okay, so the person who gives the asset becomes lessor, and the other person who receives the asset becomes lessee. Okay, that is a very, very simply stating, it's an agreement wherein one person who doesn't have asset but wants to use it gets into touch with a person who has the asset but does not want to use it and make payment accordingly. You know, it's a commercial agreement. Now there are two basic category of lease agreement. One is a pure play operating lease. Okay, where there is absolutely no ownership interest involved, and the other is the capital lease or the finance lease, where there is a ownership interest involved. Okay, so what is the difference between basically an ownership and a capital lease? When you take house on rent, okay, the idea of paying rent is not to become the owner of the house. We are just making payment because you are living in that. Full stop. But when you purchase house on finance, you are also making part payment of installment to the bank. Now those also are lease installment. That also is made by the person who does not own the house right now, which is the borrower, to the bank, which has legally the owner. So in this case, the person making payment, the borrower, has an ownership interest involved. After the entire lease period, the house will become of the borrower. Okay, you know, our parents, our friends, our family, someone else must have bought some flat, house, etc. on loan. That is an example of a finance lease. Okay, but how do you know just by looking at the cash flows, or you know, just by looking at the the different flows of value, that whether a lease is an operating lease or a capital lease? Okay, so there are these 4 pointers, very, very important pointers, and if any one of these gets satisfied, then it is known as a capital lease. Okay, so if anyone is satisfied, not all, anyone, the lease becomes the capital lease. The first point, the title to the leased asset gets transferred to the lessee at the end of the period automatically. Okay, once all payments have been made, the asset is transferred to the lessee. This will happen only when the lessee would have made the payment for entire cost of the asset. Therefore, capital interest involved, therefore a capital lease. Okay. Point number 2. A bargain purchase option exists. A bargain purchase option is basically an option to purchase something at a very, very low value compared to its market price. So imagine if a car is being valued at 1 lakh rupees right now, and I give a right to another person to buy it at any time at 5,000. So the other person has got a bargain purchase option. He can purchase goods worth rupees 1 lakh at 5,000 only. Now imagine, why would I ever give someone else a right? Why will I bear a loss of 95,000? Only when I would have already received these 95,000 in some form or the other. So again, the rule is that if a bargain purchase option exists, the lessee must have made payment to the lessor in some form or the other, therefore it's a capital lease. Okay. The third point is the lease period is at least 75% of asset's economic life. Now imagine a motor vehicle, the life of that is 5 years. If the lease agreement covers 4 years with only one customer, then law says that you have used the asset for 80% of the total life. There is nothing left for the other customer. So effectively, you were not just a tenant, you have become the owner of the property. Okay. And the last option is that the present value of lease payment, in today's term, time value for money, is at least equal to the 90% of fair value. So law is very clear that if your lease payment is equal to 90% of the cost, then you are effectively paying the total value. You are paying 90%. You are not simply a user, you become a owner. Okay. So these points will hold true even when the legal agreement is something else. Now here let me pause and take you back to my first class, wherein one of the conditions that we did was substance over form. Okay. Can you read the last bullet in the other principle? It says giving weight to the true nature of an item instead of its legal form. So as an accountant, as an analyst, it is extremely important that we pay attention to the legal form rather than paying attention to the substance. Okay. So let's talk about the accounting aspect now. Okay. So can we move to the please? Thank you. I am talking about the finance lease, and I am talking about the operating lease. Okay. Now I'm going to divide the entire board into 4 quadrants. One half for different categories, and first half and the second half for lessee and lessor. Okay. So that's how I'm going to do. This is lessee and this is lessor. So basically I'm talking about the 4 aspect and accounting from point of view of all 4. Okay. Now Ghatkopar says that the voice is coming very slow. Ghatkopar, is the voice better now? I hope it should be. Okay. So let's talk about the easier aspect, which is known as the operating lease. Now the scenario is that three payments are made by the lessee to the lessor. Okay, and for simplicity's sake and for comparison purpose, I have assumed that these remain the cash flow both for the finance lease and for the operating lease. Okay, then only we'll be able to draw an apple to apple comparison. So in case of an operating lease, my lessee, who is a tenant, gets into an agreement with the landlord and says that I want your house for 3 years, I will pay you an annual rent of 100 rupees. Okay, fair and simple. So year 1, year 2 and year 3. Cash flow. There will be an outflow of 100 rupees. it's like a normal cash outflow happening. Okay, and you can see that I have put it in the bracket because from a lessee's point of view, this is going to be an outflow, negative sign. So I have used bracket to denote that. Now understand that rent paid is what kind of an expense? It's like a normal operating expense, like salary paid, rent paid, you know. So how much portion of this amount is expected to go to income statement? The entire amount. It's like a pure play operating expense. Okay, and which part of cash outflow will this go? There are three aspects of cash flow: cash flow from investing, cash flow from operating, cash flow from financing. So this is a pure play operating expense. I will park it in my CFO. Okay, so 300 goes to CFO, 300 goes to income statement. Simple case, rent paid. Okay, so lease might look a little difficult. If you get down to the basics of it, understand the flow of figure, very simple. Okay, now tell me something. Did any sale or purchase happen here? No. Did the tenant try to acquire ownership rights here? No. Okay. Let me draw this thing for the lessor. From lessor's point of view, okay, if I have some space, I can probably put this down. Cash flow. Now for a lessor who is a landlord who will receive the rent plus 100, plus 100 and plus 100. Okay. Now from a company's point of view, any rent received or any normal business income received goes in your income statement as a pure play income. Yeah, and again, let me assume that the value of the asset here is 248. Okay, I will tell you later why did I assume this value. That the house property which I have rented out is worth 248 rupees and is going to survive only for 3 years. Okay, for simplicity's sake I am just assuming such figures. So in addition to this income, my landlord, who is the owner of the asset now, will also get to claim the depreciation. Depreciation will be 1/3 of 248. Straight line method, historical cost minus salvage value upon number of life. So 248 minus 0 upon 3, 83. Okay, so that's how I have calculated depreciation. Depreciation is an expense so your net income is plus 17 plus 17 and plus 17. Yeah, so what I have done is, in case of an operating lease for a lessee who is a tenant making payments, 300 of outflow, receiving payment is by the lessor 300 of positive inflow. In the income statement, you have total 51 rupees. Okay, simple example, no sale purchase happening. When you become a tenant and a landlord, obviously there are no ownership interest involved. Life is very simple. Okay, since this is like an operating income, normal operational aspect, this 300 received in my cash flow statement is going to be part of CFO, normal operating income. Okay, I'm not selling an asset, landlord is not taking any loan, so CFI and CFF are ruled out. CFO becomes the only head. Can you just go to the slide? Now I want to read only the right hand portion, which is the operating lease. Don't get onto the capital lease right now. Just read the right hand side. So now this analysis is from point of view of the lessee, which is the tenant in my case. Okay, so all those who've got the slide, just write here above operating lease, example of tenant. Okay, so in case of a balance sheet, there is no impact whatsoever. In case of income statement, the entire rental expense is recognized in the P&L account, and obviously no depreciation is charged. So we have taken entire 100 into P&L as normal rent. In case of cash flow statement, the entire 100 paid every year, like the lease installment, is reduced by the rental expense. Okay, so the CFO is reduced by 100, no impact on financing whatsoever. Yeah, so let's talk about the analysis from the point of view of a landlord. Again, just look at the operating lease portion. Don't get confused with the finance lease. Under operating lease, it says it is treated like lending of asset. The asset continues in the balance sheet of the landlord. Obviously, when there is no sale, the house property continues to belong to the landlord. In the income statement, lease installment received is treated as income and depreciation is treated as an expense. 100 minus 83, net income out of lease is 17. Cash flow statement, you have CFO increased by the amount of lease installment received. So the entire 100 received is taken into CFO. No investing, no financing. So that was, pretty simple. Now, can we move to the board, please? Can you move to the board, please? Okay, now this was the example, a simplified version of the lease, wherein simple tenant and landlord were there. But imagine a scenario where the ownership interests are involved. Now I am giving you an example of a borrower and a financer. Okay, what happens is, now I am just looking at one of the business cases. DLF wanting to sell house worth 248. Okay, borrower doesn't have money to pay for the house upfront. So the borrower says that let me take a loan from SBI and purchase the house. So how it happens practically is SBI directly make payment to the DLF, so in the books of SBI cash goes down and purchases the asset from DLF. So legally the bank becomes the owner, the financer becomes the owner. Okay, so in the books the house property goes up both by 248. Then what happens is borrower request SBI, can I use your house which you have purchased from DLF, and in consideration I will make payment to you, the SBI. So what happens is SBI lends the house property to the borrower who is making payment for the house. Okay, now here is the catch. The borrower is making 3 payments to satisfy a loan of 248, which is giving bank an income of 10%. So if you use your calculators to find out the EMI or equally yearly installment which is required to generate an income of 10% for 3 years on the present value of 248, can we use the calculator to find out the yearly installment? So now use your calculator to find out how much installment is required if interest is 10%, number of years is 3, and present value is 248. Okay, now quickly calculate that and send me the answers by SAS. Number of years 3, interest is 10%, and present value 248. Just have to calculate the payment. $99.72, or probably let me put it 100. Okay, just rounding it off to 100. So what happens is the borrower will pay 100 rupees to SBI for 3 years for SBI to generate an income of 10%. So with this, now from in the books of the lessee, who is the borrower? Okay, now here account for bank, opening liability, interest expense, lease installment, principal paid, closing liability. So what my borrower is going to do, he is going to make an account for the bank in terms of the loan he has taken. Okay, what are we effectively doing in the books of the borrower? We are assuming that he has purchased the asset on loan. Now we have to be mindful that my borrower is not the legal owner. The legal owner is still the bank, but the agreement with the bank says that once the borrower has made full payment of the loan, the house will automatically be transferred to the borrower. And that exactly was one of the 4 conditions which, if satisfied, will become the capital lease. Okay, so under capital lease, the assumption is that the lessee, the user, is the deemed owner. So forget about the legality of it, forget about the form of it, look at the substance. In substance, my borrower is the deemed owner. So effectively, he has purchased the house, he didn't have money, so he must have taken loan from SBI. So who has the asset in the books? Effectively, not the SBI, but the borrower. Okay, what is the role of SBI? They have just made payment to DLF, and to compensate for that, they will receive 100 rupees for next 3 years. That is what an SBI's role is, pure financing. So therefore, in a capital lease is a dual leg transaction. The first leg is taking loan from a bank, and the second step is utilizing that loan to purchase the asset. Okay, so how much is the opening liability for my borrower? Now, like in case of the bond, the value of a liability is equal to present value of the cash outflows required discounted at an appropriate rate. Now here, how much is the lease installment that my borrower has to pay? 100 rupees each year. Can you calculate the present value of the 100 rupees discounted at 10%? Can you use your calculators to find out the present value of 100 rupees discounted at 10%? So here your payment is given to be 100, N is equal to 3, interest is equal to 10%, find out PV, present value of payment of 100 for 3 years. Now Pune, I think Chandigarh has given the right answer, 248. Now Pune, what you are doing is you are basically assuming that there is only one installment at the end of either the first year or the third year. Now the point is there are 3 installments, first year plus, second year plus the third year. So what the figures you are sending me, you need to cumulate them and find out a present value. Okay, so the answer is 248, and this was precisely the reason why I had taken 248 initially. Okay, so for my borrower, 248 is the opening liability. Same time value for money concept like I used to do in my bonds. Okay, interest expense, opening liability multiplied by market rate. 24.8, 24.8, let me round it off to 25. But how much lease installment has been paid by the borrower? 100. So that means out of 100, 25 must be the interest and 75 must be the principal paid. If out of 248, 75 principal has been paid, then what remains is 172 or probably 173. So for the next year, my liability becomes 173. Again, 17.3, 10% of the opening liability. Let me round it off to 13. Lease installment paid 100, so principal payment is only 83. Out of 173, 83 paid this year, remaining is 90. Interest expense 9, 10% of 90. Lease installment 100, principal repaid 90, closing liability 0. Now there is like a discounting gap. Principal repaid is 91, but since my opening liability was 90, so I've assumed it to be 90. If you calculate it to the 2 decimal places, you will get the exact answer. So let me just total this up. How much is the interest expense paid? 51. How much is the total cash outflow? 30. How much is the principal paid? 248. Probably, yeah. Okay. Now, out of the total cash outflow of 300, which has been paid by the borrower, 51 has been spent in making payment for interest, and the balance 248 or 249 is spent in paying the opening principal. Okay. Total cash goes down by 300, out of which your opening liability becomes 0. So liability goes down by 248, and 51 of 52 is taken to the income statement as a normal interest expense. Okay, so this is a statement which is prepared by lessee for the bank. Now tell me something. Out of this, which I can see, this goes to my income statement, since this is like an interest paid. Now in this case it's a finance lease, so I have made my lessee as the deemed owner. So who will claim the depreciation? The deemed owner will claim the depreciation. So here the depreciation will be 83 each year. So therefore the total interest and depreciation that will go to income statement is going to be 83 plus 25, 108. Second year में 83 plus 17, exact 100, and in the third year 83 plus 9, 91 or 92. Okay, so in case of a borrower, that is how a loan schedule is prepared. How much is the opening liability? Goes in the balance sheet. Interest expense during the year, out of which paid 100. So 25 and 100, so must be 75 is the principal payment. So the principal payment remaining is 173. It becomes the opening liability for next year, so on and so forth. If I look at the cumulatives, the lease installment total payment is 300, out of which 51 or 52 is my interest, and 248 is the principal paid. Okay, so that's how statement is prepared. Important point to notice, in case of a finance lease, you have the borrower as the deemed owner who gets to claim the depreciation. Therefore, the amount of hit your income statement takes cumulatively is 108, which is comprising of 83 of depreciation and 25 of interest. Then 100, which is 83 plus 17, and then 92, which is 83 and 9. Okay, so that just completes the lease, the lessee under the finance lease. Now I want you to pay attention to a very important comparison which I am going to make now. I am going to compare lessee under finance lease with lessee under operating lease. Point to point comparison. How much is the total hit on the income statement? 300. How much is the total hit on the income statement? 300. Total expense charged is same. Second point. In the first year, the expense charged is 108 compared to expense charged only 100. Therefore, greater expense charged here, expense is high, so therefore profits are low. Therefore, between the two categories, it is my finance lease which gives you a lower income in the first year because the expense is more, and the opposite is true in case of the last year. Only 92 rupees of expense compared to 100 in the operating lease. Okay, let's talk about cash flows. In case of an operating lease, everything was CFO. So entire 300 got deducted from CFO, whereas in case of finance lease, my borrower, out of the total cash flow of 300, 51 is operating because it is interest paid as per US GAAP is operating, and 248 is financing. Okay, so here, but in case of operating lease, nothing goes out of financing. Everything goes out of operating. Remember, this is a cash outflow. So greater the deduction, lower is the net cash flow. So in case of operating lease, since entire 300 goes out of CFO, my CFO is lower by 300. In case of financing, CFO is lower only by 248. Lower deduction, therefore higher net balance. Okay, let's look at the anything else in particular. No, there is a request to show assets and liabilities in these books year wise. Okay, so let's talk about year 1 opening. The first day of year 1, my opening liability was 248, and on the asset side it was full 248. So asset goes up, liability goes up on the date of lease. Year 1 closing, you have liability value being shifted to 173. Out of this 248, 83 has been depreciated, so what is left is 165. Now we have to mind that these two will never go equal always. They will be equal only at one point in time, at the beginning. That is about it. After that, asset will be depreciated according to a different rate and liability will be paid off according to a different rate. Year 2 closing. Your liability in form of a bank loan or a lesser, it is 90 and my asset are out of thing 83 again depreciates, so remains 83. At the end of year 3, how much is my liability? 0. How much is my asset? Fully depreciated, equal to 0. Okay, so it is only here that my assets are going to be equal to liability, otherwise these will be unequal. Okay, so can we go back to the slide?